So, you want to get into options trading? Awesome. But before you dive in, let's talk about the biggest mistakes to avoid. Options can seem complicated, but once you get the basics, they're a powerful tool. The problem? Many new traders jump in without understanding what they're doing and lose money fast. This video is for beginners or anyone who's realized options are more complex than they thought. We'll keep it simple and practical, focusing on the real-world mistakes that cost people the most. By the end, you'll know what to do, just as important as knowing what you do. Let's get started. So, what's the number one pitfall that trips up aspiring options traders? It's diving headfirst into trading options without truly understanding the fundamentals. It's like trying to build a house without knowing how to lay the foundation. Too many people hear about the potential for big, quick wins and jump right in, fueled by excitement and the allure of fast profits. They see the headlines, the success stories, and they want a piece of the action immediately. Often, they're doing so not even knowing the basic definitions like what a call option is, or what a put option even represents. They're essentially gambling, hoping for the best, without any real understanding of the risks involved. So, before you even think about placing a trade, here's what you absolutely need to know. First, a call option gives you the right, but not the obligation, to buy a specific stock at a predetermined price. This purchase can be made at a set price, known as the strike price, and it must be executed by a certain date, which is the expiration date. Conversely, a put option lets you sell a stock at a set price, offering you a chance to profit from a stock's decline. This sale must also occur by a certain date, the expiration date, making timing a critical factor. The strike price is the specific price at which you have the right to either buy or sell the underlying asset. It's the cornerstone of your potential profit or loss. Therefore, picking the right strike price, one that aligns with your market outlook and risk tolerance, is absolutely crucial for success. The expiration date is essentially your deadline in the options world. If you don't exercise your option or sell it before then, your option contract expires and becomes worthless. It's important to remember that options lose value over time, a phenomenon known as time decay or theta, which eats away at the option's premium as the expiration date approaches. So, before you even consider placing a trade, you need to fully understand the type of option you're trading, whether it's a call or a put, the underlying stock or asset that the option contract is based on, the strike price, which determines your potential entry or exit point, and the expiration date, which dictates the time frame you have to be right. Mastering these basics is absolutely non-negotiable if you want to succeed in the world of options trading. Before you even think about risking your hard-earned real money, take the time to practice with a paper trading account. This will allow you to see how all of these variables interact and work in real time, all without putting your actual cash at risk. Invest the time in learning these concepts now. Dedicate yourself to understanding the nuances, and you'll save yourself from making potentially expensive and avoidable mistakes down the road. Don't be the person who learns about the devastating effects of time decay only after they've already lost a significant portion of their trading account. Instead, be the person who knows the rules of the game inside and out, before even stepping up to play the game. Build a strong foundation of knowledge first. Only then should you consider starting to trade with real money. Remember, in the world of options trading, knowledge is your single best defense against costly mistakes. Mistake number 2, underestimating the risk. It's easy to get caught up in the excitement of potential gains, but a clear-eyed assessment of the downside is crucial. Social media is full of stories about huge overnight gains, painting a rosy picture of easy money. But you rarely see the thousands who lose everything, quietly licking their wounds away from the spotlight. Remember, social media often showcases the exception, not the rule. Options are leveraged. You control a lot of stock for a small amount of money. This is both their allure and their danger. That leverage can double your money, and it can do so very, very quickly, or wipe you out. The same force that amplifies gains also magnifies losses. With options, you can lose 100% of your investment, and you can lose it faster than you might think. This can happen even if you're right about the direction the stock will move. If the stock doesn't move enough within the options time frame, or if volatility decreases, you can still lose money. Only trade with money you can afford to lose. This is the golden rule of options trading. This isn't your rent or emergency fund. Never risk money that you need for essential expenses. Treat it like a trip to Vegas. Set a limit, and if you lose it, walk away. Don't chase your losses, And don't let emotions dictate your decisions. Start small, even if you have a bigger account. There's no need to jump in with both feet. Try one contract to begin with. Feel the real emotions and learn how fast things can change. Experience the volatility firsthand, but with minimal risk. If losing your investment makes you panic, you're trading too big. Reduce your position size until you can trade without fear. The goal isn't to get rich quick. That's a recipe for disaster. It's to stay in the game long enough to learn, to develop your skills, and to build a sustainable trading strategy. Respect the risk, or the market will teach you the hard way. And trust me, the market is a very unforgiving teacher. Survive your early mistakes so you can improve. Every mistake is a learning opportunity, but only if you're still around to learn from it. Don't blow up your account on your first few trades. Preserve your capital so you can continue to learn and grow as a trader. Manage risk first, profits second. If you protect your capital, the profits will eventually follow. Overleveraging is a fast track to disaster. It's a siren song that lures many inexperienced traders towards the rocks. The promise of quick riches can be incredibly tempting, but the reality is often a harsh lesson in risk management. It happens when you risk too much of your account on one trade, essentially betting the farm on a single outcome. This can stem from a variety of factors, including a lack of understanding of risk, or simply succumbing to emotional impulses. It often happens after a lucky win or a burst of confidence. You might think you've cracked the code, that you're invincible, and that every trade will be a winner. This is a dangerous mindset that can lead to reckless decisions. For example, putting half your account into a single trade is reckless. It's like putting all your eggs in one basket and hoping for the best. It's reckless even if you feel absolutely sure about it. The market is unpredictable, and even the most well-researched trades can go south. If you lose, you need to double your money just to break even. That's a huge hurdle to overcome, and it puts immense pressure on your next trades. Professionals risk just 1 to 2% of their account per trade. They understand that consistency and longevity are more important than chasing quick profits. On $2,000, that's just $20, $40. It might not seem like much, but it's a responsible way to manage your risk. It sounds small, but it keeps you in the game. It allows you to weather the inevitable losing streaks and stay focused on your long-term goals. The other danger? Using margin. It's like playing with fire. That's borrowing money from your broker to trade more than you can actually afford. It amplifies both your potential gains and your potential losses. Margin plus options is a recipe for disaster, especially for beginners. It's like mixing volatile chemicals without understanding the consequences. If a trade goes bad, you could owe more than you have. You could end up with a negative account balance and a mountain of debt. So, set strict position size rules. Define exactly how much you're willing to risk on each trade and stick to it, no matter what. And avoid margin until you're truly experienced and have a solid understanding of risk management. It's a powerful tool, but it can be incredibly dangerous in the wrong hands. Protect your capital above all else. It's the lifeblood of your trading career. Without capital, you can't trade. It's as simple as that. Stay disciplined, keep your risks small, and focus on consistent, sustainable growth. And ignore the temptation to go big. Resist the urge to gamble and treat trading like a serious business. Survive first, thrive later. Focus on preserving your capital and learning the ropes before you start chasing big profits. That's how you build longevity in trading. It's a marathon, not a sprint. Trading without a plan is just gambling. Every trade needs a strategy entry point, profit target, and stop loss. Know why you're entering? Don't just follow a hunch or social media hype. Set a profit target. When will you take your gains and get out? Without a target, greed takes over and you risk losing your profits. Just as important, set a stop loss. Decide in advance when you'll cut your losses. This is your safety net, preventing small losses from becoming disasters. Write your plan down before you trade. Entry reason, target, stop loss. When emotions run high, follow your plan, not your feelings. If your trade hits your target or stop, exit. No second guessing. This discipline protects you from emotional mistakes. Treat your plan as your rule book. Trading is a business, not a game of chance. Stick to your plan and you'll avoid the worst pitfalls. Don't improvise in the heat of the moment. Consistency beats luck every time. Plan your trade, trade your plan. Chasing losses, also known as revenge trading, is a dangerous trap. You take a loss, feel the sting, and try to win it back fast by jumping into another trade, often with more money. This emotional spiral usually leads to even bigger losses. You double your risk, but your judgment is clouded by frustration. One bad trade turns into a string of worse trades, and your account can disappear in a day. The key? Accept that losses are part of trading. Every pro takes losses. It's normal. The difference is how you respond, accept, review, and move on. If you're upset, step away from the screen. Don't trade until you're calm and rational again. Each trade is independent. Don't let a past loss dictate your next move. Recognize the urge to chase losses for what it is, an emotional impulse. When you feel it, walk away. Your account will thank you. Trading is a marathon, not a sprint. Don't dig a deeper hole. Learn, reset, and come back stronger. The biggest challenge in trading isn't strategy, it's managing your emotions. Fear and greed are your main enemies. Greed makes you hold winners too long or take on too much risk, chasing that big score. Fear makes you panic sell or cut winners short, missing out on gains. Both lead to abandoning your plan and making poor decisions. The solution? Stick to your plan, no matter what. Keep your position sizes small so losses don't feel overwhelming. Discipline and patience are your best tools. Trading isn't a video game, it's a business. Treat it professionally, and don't let emotions drive your actions. Mistakes will happen, but learn from them. Over time, you'll get better at staying calm and rational. The goal is consistency, not perfection. Control your emotions, and you control your results. That's the real edge in trading. The final mistake? Not reviewing your trades. Most beginners move on after a win or loss, missing a huge learning opportunity. Your trading history is your best teacher. Keep a journal log every trade, your reasons, your emotions, and whether you followed your plan. Review your journal weekly or monthly. Look for patterns. Are you losing in certain setups? Breaking your rules after losses? These insights are gold for improvement. For example, if most losses happen in the first 30 minutes of trading, avoid that window. If you ignore stop losses, work on discipline. Reviewing is how you turn mistakes into lessons. Don't waste your tuition to the market. Learn from every trade. Treat trading like a skill to master, not a game of luck. Improvement comes from honest reflection. There you have it. The 7 biggest mistakes new options traders make. Avoiding these pitfalls is the fastest way to improve. Success isn't about secret indicators or overnight riches, it's about discipline, consistency, and learning from your mistakes. Don't get discouraged by losses. Use them to get better. Aim to improve just 1% with each trade. The goal is to be profitable, not perfect. If you found this helpful, like and subscribe, and share your experiences in the comments. Thanks for watching. See you in the next video.